So the building is actually built around the product, I guess you could say, and in terms of security, the layers of security, the thought process, nothing was done just to look good. It was really built like with the gold being the central aspect of the building and build it outwards and design it outwardly. But it's our second vault in Cayman. We outgrew the previous vault, which you guys had visited before. So everything is new and shiny and exciting right now, and we're looking forward to filling this place up again.
All right, here we are with Mark Yaxley and the rest of the Resolve crew. You'll recognize Rodrigo and Mike a little further away than usual because today we're filming from inside the Strategic Wealth Preservation Vault with Mark Yaxley of SWP hosting. You'll see the actual real gold bars directly behind us. And so I think this is going to be a really different and pretty novel and interesting episode. So Mark, let's start off with what is SWP and how did you guys come about?
Yeah, well, first of all, guys, welcome to our Cayman Islands vault. We've never actually done this kind of format inside the vault before, so it's pretty exciting to be with you. SWP came about, actually, was an idea that was born around 2010. There was a family here in the Cayman Islands that had been investing in gold and silver for a long time. And they recognized that Cayman had a little bit of everything in terms of financial services. Obviously, companies like your own, you had the banks. And they're like, you know what, this island could really use a gold vault. And that's kind of when the idea was born. And fast forward about 4 or 5 years of planning, doing market research to see what else was out there in other offshore jurisdictions in particular. We opened our doors in 2015 to the public.
Fantastic.
Amazing. The Christmas edition in silver and gold, baby.
That's
It
right.
couldn't
It
get
is.
more festive than this.
I mean, it is a pretty spectacular, just the facility itself is, as you guys built it basically a few months ago, it's been done, right? So it's top of the line. It seems like a MI2 movie.
Yeah.
This
with all
building
the
is
fingerprints
custom
and-
built for this purpose, right?
It is. So the building is actually built around the product, I guess you could say, and in terms of security, the layers of security, the thought process, nothing was done just to look good. It was really built like with the gold being the central aspect of the building and build it outwards and design it outwardly. But it's our second vault in Cayman. We outgrew the previous vault, which you guys had visited before. So everything is new and shiny and exciting right now, and we're looking forward to filling this place up again.
We propose to film us walking in through all the different security protocols and then realize that probably don't want to give away all of the security steps. That's pretty neat.
It's a hard no. This is a secret location, really.
That's true.
when
I know you
think
guys were
about it.
excited.
That's
I
true.
know.
Yeah,
I
I'm
sense
super
that.
excited. This is amazing.
So how does SWP differ from other ways that people have typically and historically bought gold bullion?
Yeah, I mean, the biggest USP for SWP is the Cayman Islands. I mean, we're the only precious metals dealer and obviously the only storage facility like this in the Cayman Islands. And the advantages that this jurisdiction provides to clients, not only for those who choose to store here, but also those who transact through the company and store it elsewhere in the world. That extra layer of privacy and confidentiality is very valuable to some people. And I'd say that's really where the unique selling points for this company begin. And obviously we try to treat people well. You know, everybody says that, but we actually treat our clients like human beings, not numbers. It's a long-term proposition. When you run a gold business, you know, you're not in it for a quick buck. You know, so you don't nickel and dime your clients. You don't bend them over. You treat them well, and you hope that they and their families stay with you for a long time.
Yeah, and it's amazing to see an actual physical bearer asset in form, in its secure location, with bars that are numbered in a way that guarantees that your bar is your bar. It really is something that it's almost a days of yore thing. You know, the whole, what was it, the 30s when no safety deposit box in the US would be opened without an IRS agent present, those types of things. And today we're in this digital world where everything gets digitized and can be rehypothecated and whatnot. But then you see the granddaddy of them all, the 5,000 year sort of first physical bearer asset in modern finance. It's a surreal experience,
Yeah,
to be honest.
it is pretty old school, you know, and to some people that's not attractive. That's not sexy. It's not flashy, you know, digital assets. Obviously, tend to be, top of mind and top of conversation, but there's a lot of people that still enjoy saving their money this way.
Digital assets, not your keys, not your coins. I mean, part of the whole world of digital asset revolves around the fact that you have a finite, in the Bitcoin sense, you have a finite number of these things that will be created, and you, through this other mechanism of accounting and tracking, have real ownership of that thing. So it's sort of everything that's old is new again. The idea of custodying your securities and your certificates and just holding them in street name at the brokerage house. I mean, when I entered this business, people were still bringing in certs. Like, you'd have a cert, they'd have it at home, they'd get their dividend checks, and those people were products of the Depression and of an era where banks failed and things failed, and having your assets held in some other name other than your own didn't actually work. And so it's just really interesting that what's old becomes sort of new again, and it's a layer of security that's very it's very meaningful in the accumulation or storage of your wealth.
And I think that idea of wealth preservation is much more poignant for third world countries. I'm Peruvian. I know how important physical things are to them, whether it's owning real estate, owning businesses that they know they have control over, and owning precious metals. Bitcoin's become a huge thing because of the inability to transact across borders, right? So that's one of the things that I think is a good use case for the cryptocurrencies, maybe the only use case in a lot of cases, but the ability to physically own things it's much more important in places like, let's take Argentina right now, for example, right? Where you have inflation over 100% and no end in sight. Maybe Malay is going to do something about it soon, but the reality is that the only way to maintain any sort of purchasing power is by owning hard assets. And this is an important aspect of it. In a way that in a financialized world in the Western countries, it continues to be a struggle to when I ask a room of people, how many of you have over 5% of gold in your portfolios, and nobody raises their hand. How many do you own any physical gold? And only a handful continue to raise it. It's like we've forgotten that anything could go wrong. But if you look at history, it's so clear that there's always a place for that diversifier, and it is, excuse my language, an MK shit type of thing that you actually want to have, right? What happens if and when you need hard assets, real estate being one of them, but then what is the added benefit away from real estate? Maybe I can ask you, in terms of the fungibility of gold bars and physical gold, when let's say something does happen, what do you see the easy way for people to access their gold and precious metals wealth for transactions?
Well, I mean, gold is very liquid, and I think that's one misconception that people don't have, especially physical gold. They know ETFs are liquid, right, but they may not understand that you can buy and sell physical metal just as easily these days with the use of technology and online shopping carts, or just picking up the phone and emailing your dealer broker. You can do that. So in terms of liquidity, in a crisis or a crunch, you can access cash really quickly. And these days, companies like ours will even couple that with cryptocurrency. So if you want to get paid in crypto, we can do that. So from a liquidity standpoint, certainly not an issue. I think just going back to what you were saying previously about crises and such, really the positioning for gold is wealth insurance as a general positioning, and why do people own this stuff. And I think there are much better ways to make money, and we never advise anybody to buy gold to make money, which sounds weird to a lot of investors. You have to get over that hurdle first.
Return of capital.
Yeah, exactly. But a lot of our clients, especially wealthy clients who have already earned a lot of money through their businesses, through their other investments, at that particular stage in life, all they want to do is preserve that money. And when gold really, obviously, some historical examples, 2008 financial crisis, COVID crisis, that's when gold really surges and helps protect the overall value of their portfolio as a true diversifier, because there's not many asset classes like gold. And it really does hedge well in a crisis situation, whereas the real estate market in 2008 took a hit as well. So even if you owned a home, you took a pretty big hit.
But and I think if you think about it through the lens of also a market capitalization perspective, if you think about, well, I have the S&P and I'm diversified. Well, if you look in the S&P, there isn't much in the way of metals and mining producers as a percentage of the market cap. it's I think less than 1%. It's very, very small. Even oil and gas is only 5%. So here you have, in the context of this insurance asset, this return of capital, this solid asset, and then you look across your traditional portfolio, and if you're just considering those financial assets, well, you're extremely underexposed from a global asset perspective as a market cap of what's precious metals, maybe, is it 10 trillion, something like that in market cap? And if we sort of say there's 100 trillion in global assets generally, that's maybe 10%, maybe double it, it's 200 and it's 5%. You're just not getting any of that exposure through sort of traditional market cap type holdings, whether they include international stocks or not. And so on top of that, you have this kind of lack of insurance from just looking at it from a global market perspective.
But I'm just looking up right now. So from March 31st, 1973, I guess that's when gold went free floating. It's no shrinking violet in terms of nominal returns, right? You got a Sharpe ratio of 0.4, annualized return of 6% for gold. Now, it seems to me that this is above the risk-free rate long term. So it's also providing some sort of real return above cash from what I'm seeing here anyway. And because of its unique non-correlation from a portfolio construction perspective, that rebalancing premium that you get from matching it up with bonds, with equities, maybe other commodities, you actually, it becomes another piston to a portfolio engine that can actually smooth out the ride a little bit more, right? So you're getting an excess return in a portfolio basis from non-correlation. You're getting that security. You're getting that place of last resort in case everything else goes down. Your bank goes down, you can't get access to it, and you can walk into your vault and pick it up and start, I guess, shaving it off to start transacting in the zombie apocalypse.
Not all bars are this large, so
Right.
you can go into smaller denominations, and that's probably another misconception that's worth mentioning at least is the people, when you mentioned earlier, you were in a room of 100 people and you said how many people invest in physical gold, and I think there's a misconception that you have to be extremely wealthy to invest in gold.
Yeah.
It's obviously not true. I mean, an ounce of gold only costs $2,000 US, an ounce of silver is $25. So the entry point is $25 US to be in the precious metal space. So again, that's just a lack of education in general. And 100 years ago, this conversation would have been totally different because people carried gold as money in their pockets. But like you said,
Right.
we've forgotten.
I do think that there are lots of people who recognize the value of gold as being something completely different than anything else in their portfolio. And there are other ways to get access to exposure to gold, right? So, through the GLD ETF or through gold futures, et cetera. But unsurprisingly, I know, Mark, you've done some research on the pros and cons of some of these other ways of getting access to gold, even sort of just going to your local bank and getting exposure, buying some bullion from them, right? So maybe just walk us through some of those different options so that people understand what the trade-offs are.
Yeah, or Costco more recently.
Yeah, right.
Obviously, we can talk about that
really?
a little bit. Yeah. Up in Canada, they sold out. They had a 2-bar maximum. Now we brought it up. So Costco announced that they were in the gold business. You could order online, so you couldn't go to the store and get it. You did get your 2% cash back, though, which was also very attractive. But they maxed it at 2 bars per client, and they sold out, and it was headlines all over the place. But
2 bars of what?
1 ounce gold bars.
1 ounce gold bars.
Yeah. But which was a really great headline for the gold business. Obviously, anytime a major retailer, steps up and starts creating waves, that's great. But the truth is, major retailers like Walmart have carried gold for a long time. So it's not really new. It's just that Costco did it for the first time. But
Walmart carries it?
yeah, in the States, yeah, you can order gold online.
No idea.
Yeah. Right. eBay, Amazon, any major retailer, you can find gold and silver. But to your point, I mean, for a lot of people look at the mining stocks, and I don't follow the mining space very, very closely. But my advice, having had dinners and many drinks with guys who are in the space, is 9 out of 10 of those juniors are dogs. And if you don't know what you're doing, you are going to lose money. So either pay someone who knows what they're doing, or do your homework. So for most average investors, I think trying to stock pick miners is a very risky way of getting exposure to gold. ETFs make a lot more sense in terms of usability, cost of entry. If you have a shorter term that you're trying to capitalize on the precious metals market, 3 to 6 months, I've used ETFs, definitely. I think it's a great way to do it.
How do those ETFs custody gold?
This is where I was going with this. So after many, many years of people asking me what's better, ETFs, physical, why would I buy physical and pay you guys storage when I could just do it through the ETFs? I read the fine print, and it was lengthy. It was a deep read. I was on a long flight somewhere, and I said, finally, I'm going to do this. And what really struck me, obviously the funds themselves try to de-risk themselves and de-expose themselves from any kind of potential, third-party risk. But what it really boiled down to, and what caught my attention, Adam, is that a lot of the risk was shifted to the custodian. And in this case, the custodian was a very large financial institution in the US, one that did not have a good reputation when it came in terms of managing physical metal, because they had run a desk for many, many years, and that desk had actually closed because they did a horrendous job and they had lost a lot of physical metal that belonged to people. And when I saw that name at the bottom of the fine print, that they were the ones ultimately responsible for taking care of the underlying asset, I became very concerned. And if you're an investor and you think, I'm doing this to save myself a quarter point or half a point, on my cost of entry versus physical gold, you're like, is it really worth that added risk of dealing with a large American financial institution whom is not going to fully allocate and segregate that metal? They're going to loan it, lease it, commingle it. They're going to do what they can to make money from that underlying asset.
So
Street name.
because this is the part that I think people misunderstand and would love some clarity on. So you hear these stories of a person that thought he owned gold at a certain bank goes and tries to grab it, and they simply do not have those inventories, right? The rehypothecation. You say the banks are going to do all these things. If everybody goes to the bank at once and tries to withdraw their gold, what tends to happen? Like, what is the outcome?
I mean, all I can do is share stories that I've heard through my time in the industry. I've never worked for a bank or been privy to how they manage their gold bullion inventory, other than having audited the very same financial institution that I won't name for fear of what could happen. But I did do an audit of that vault when I was a very young man. And true story, we found a wood coin in their inventory that belonged to our company within their vaults. And I'm like, okay, if you've got a wood coin that's infiltrated your inventory, we've got problems. And that's just goes to show how little they actually cared. They cared about what the balance sheet looked like, and they cared about that bottom line, but they certainly didn't care about the quality of the products. Another story that I can tell you is that I worked for a large precious metals dealer prior to coming over here to SWP, and they had what's called a pool program. So this is where basically it's unallocated gold. So as a client, you pay a very low premium over the spot price, but you sign away any kind of allocation and segregation of the asset in your name. And you're basically saying, I'm comfortable with this company maintaining a position of ounces. What that position is very undefined. It could be scrap metal that's going to a refinery, so it's in transit, hasn't even been melted yet. We think we have so many ounces. We've got futures contracts. We might have a spot price hedge in place. Basically, whatever total ounces they held as a company, that was their promise to you. But when this company got in some trouble for owing some tax money to the government, all of a sudden that property and who that property belonged to became a really big deal. And if you're a client, basically a creditor of this company, you're now saying to myself, don't I wish I had paid 0.5% more to have a bar on a shelf with my name on it or in a box that belongs to me?
So let's unpack that.
Very, very similar to a brokerage house goes down and your securities are at the brokerage house and the account's a margin account and your securities are now commingled and now they fall under bankruptcy law and they are not your assets anymore versus having this, accounted for. Maybe you can walk through the actual process here of how it works and how it's accounted for so that people know that bar has your name on it almost.
Yeah.
But
yeah. So
go
before
ahead,
we do that, I just
Yeah.
want to, because that's an interesting case. I hadn't thought about that, right? So you have a company that pools these assets. You mentioned there's gold coming from scrap metal, gold or whatever, that if you wait long enough, you're going to get that. You have a futures contract that if you wait long enough, you should get delivery of that. And then you have, other methods that you might have mentioned. Now, if the company's financials, because you're doing all those derivatives trades, there are, I guess, tax issues that you then have to account for. These negative externalities that you have to account for that might affect your cash flow negatively. And then you have to, as a company, come up with the money, I guess. And it might infringe into the assets of your owners, right? So yeah, I kind of see the dangers there of having those pool assets. In contrast to that, how does a fully segregated company work? Like,
Yeah, I mean it's pretty boring actually. It's pretty vanilla. It's so when you buy any particular product, so let's say 1 ounce Royal Canadian Mint Maple Leaf coin, it's for the second best selling coin in the world. So you say I want 10 of those coins. You buy them from a company like ours. We're not the only ones out there. A lot of people do this. You actually get a tube of physical coins. There are 10 coins in there, and then that tube is placed in a bin, which behind us here you can see some of these segregated bins. They belong to individual clients. They're sealed. They have a license plate on them. So we say it's fully allocated because we've got the 10 coins that you purchased, and it's fully segregated in the sense it's segregated from your neighbor's holdings. What's most important here, and I was going to raise this before, Mike, is it's considered personal property under the law. So this isn't on the company's books. This isn't asset and offsetting liability on the company's books. It is personal property that belongs to our client. So if we mismanage our company, mismanage funds, whatever it might be, the government says we owe them tax money, whatever the case is, it's very easy to prove that that asset belongs to our client. And it's very easy for
the stakeholders or the shareholders of the company are on the hook, not the clients of the company.
Yeah, and even further so, if the company were to go bankrupt, it's not an asset on their books anyway, so it's not subject to creditors at all. So it makes things very, very clean. But again, for that, you have to pay a little bit more for your physical bars and coins. You have to pay a little bit in storage, and that's the decision ultimately that people have to make.
Right. And I don't know if this is a good jumping off point for some of the programs you have here to actually, if you did as an owner of gold personal property at SWP, where you could do some loaning of that asset, where at least you're the one deciding on that and you're the one actually receiving the benefit, rather than having it commingled with some other organization who at best may give you free storage, right? So it reminds me of the social media story, right? If you're not paying for the app, you're the product, right? So if you're not paying for your storage, whatever you're storing is being used on your behalf and they're making a profit. So it's kind of that catch-22 where at least you have a program. Maybe you could go into that. Do you feel comfortable chatting about that and just kind of laying it out? But at least specifically you decide and you would prosper to the extent you want to.
You've nailed it, Mike. I mean, that's exactly why companies offer these things. The banks and refineries do it best. In fact, we had an offer recently where a large refinery, we had a client similar to someone who holds about this much gold. They were looking to do something and the refinery said, oh, just move it to our London vault. We'll pay you 75 bips. So you'll pay us or our client 75 bips to move his gold into your vault. How does that work? What are you going to be doing? Well, obviously they're going to monetize it, right? So they don't hide it very well. But to your point, that's exactly what they're up to, whether it be a pool account or whether it be a large refinery. And where were we going with this? You wanted to
the
lending.
The lending. So you guys do have some programs too.
Yeah, we do have a program here. I won't spend a lot of time talking about it, but if you do hold fully allocated, fully segregated gold or silver with us, you can borrow cash against that. So we match the borrower or our client with a lender, and usually they're 1-year terms. Loan to value ratio is 75%. So there's very little risk to the lender. Because they know the underlying asset is gold and silver, and we have margin calls in place to protect them. And the borrower, with questions free, simple application, a lot less troublesome than going to a bank for a loan, a lot faster than here in Cayman. They can borrow up 75% of the value of their metal. Right. Yeah.
So this is private loans, private individuals are
Yeah,
making those.
exactly.
Loans. I see, interesting, yeah. As opposed to, again, is to revisit how this is typically done. At a bank, your gold is commingled and the bank is going to loan against, the bank's going to, commingle the gold as assets on their balance sheets and then they'll make a loan against their balance sheet. And so there's no segregation on either side, whereas this is a private arrangement.
Yeah,
that's neat.
What's the client mix here? Is it all retail? Is there retail in some institutions? Are there funds that store their gold here or in other vaults around the world that you guys have arrangements with? Not to mention any names, obviously that'd be upside, but what's that institutional retail mix?
Heavily retail. I would say 90% retail. We've got some trusts in here, some foundations, very little institutional business. Institutions, in terms of gold, tend to look for exposure in other ways. Mm-hmm. And that's just, a different mentality. It's a different crowd. So they tend to stick to their own. They'll go to the financial institutions as custodians for metal in general. Okay. And there's, again, I'm not going to say that's the unwise choice for them. They have those relationships, but here in Cayman, also it's not a COMEX or an LBMA approved facility, which means all the metal that is stored here is outside the chain of custody, they call it. So yeah, most of those funds will use vaults that are COMEX and LBMA approved.
And also, so then how does gold re-enter the system? Is there a testing process? How does, so there's gold bars behind me, they now go, someone decides to sell them, there's to stay, whatever. They re-enter what did you call it? What was
Chain of custody.
the chain of custody?
Yeah, chain of custody. So there's an agreement amongst certain financial institutions and members of the LBMA and the COMEX that they've decided that the Brinks facility in Jamaica, New York would be considered a COMEX approved facility. And so anything that enters that facility and doesn't leave would be considered within the chain. So in the case of these 400-ounce gold bars, if they were to be repurposed or try to re-enter the chain, they'd actually have to be melted, recast by an approved refinery, and then deposited into one of those facilities. So that's another reason. And Cayman is not, it's not a hub. This is a long-term storage depot.
Right.
Basically, this is the offshore side of the coin. Yeah.
So what about, I know that you guys have arrangements with other vaults globally. So is there a way to kind of send your gold to somebody else, or simply do a swap? You're in, I don't know, Germany, want to take out some of your gold bars, and there's a program there.
Yeah, two ways to do it. You can either ship it. So you do that through common carriers like UPS or FedEx. And I know people shudder immediately. It's like, oh, the FedEx guy left at my front door. It's fully insured, adult signature required, all those kinds of things. We only ship to the United States and Canada. We don't ship via FedEx to many countries because of corruption, border, issues at the border, criminality, all that stuff. We'll also deliver to any vault around the world. So any vault within, a recognizable network we'll deliver to. But the easiest way to do it is the location swap. So if you had a 400-ounce gold bar here in Cayman and you wanted the equivalent amount of ounces in Singapore, we'll do a we buy transaction here. We'll buy it from you. With the proceeds, we'll sell you the gold in Singapore. It's a very easy way to do a transaction. And one of the benefits for the client is they avoid, what our clients would consider a paper trail, where metal is flowing out of one country into a new country. They kind of, they like privacy and confidentiality, so we can execute that swap for them.
So one imagines that if I grab my gold bar, put it in my pocket, and head to the airport, you have more than $10,000 worth of currency. But there's no issue taking my bar from here somewhere else, with the exception of the fact that I'm probably going to be on a list somewhere. Is there, like, if I walk in with a bar into Canada and
it's personal property. Another beautiful thing about personal property is, as the owner of that personal property, you have very strong, from a legal perspective, you have a lot of support in your benefit. The government has no title to your personal property without, doing, if you had committed a crime and they could tie it to proceeds of crime. But I've traveled with gold and silver many, many times in my career. I actually enjoy doing it once in a while, just to get kind of the rush of retesting the system. Like, what are they going to ask me? What forms are they going to fill out? How difficult is this? And generally, it's very simple. And they know your rights. I mean, these guys are, if there's one thing that the customs guys are trained for, is they know when you're within your rights. And, I've done it at JFK, New York, one of the roughest airports to enter. You're entering the United States, they treat you, like garbage. And then, you're like, oh, I have over $10,000 worth of gold bars in my backpack. And they're like, well, let's go have a chat. And honestly, they take a look at it. They're like, where are you going? Going home to Canada. It's personal property. They're like, hey, have a good day. Thanks for letting us know. So if you don't declare it and then they find it, that's when you're going to have a longer conversation.
And so the fact that,
it's a little heavy.
So now that you're stopped all the time for no apparent reason at customs, you still think it's a good idea?
I'm not, actually, believe it or not. I don't have that problem. Usually security, when you go through security, it's going to come up on the x-ray machine as a very dense material in your backpack. And that's really the point where you're going to have the longest delay. Is the security guy's going to want to check your bag, and she or he doesn't have any idea what they're looking at. So you usually have to tell them what it is.
Right.
Yeah.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investresolve.com. Now back to the podcast.
That's very interesting. I mean, the fascinating world of traveling with gold. Would it be any different with currency that you know of? Probably be the same process.
No, you just have to declare it. It's the same thing on that declaration form. Usually it says cash or equivalent, which, in most places they consider gold or silver an equivalent. Yeah.
And platinum, palladium, silver, it's private property.
It's private property. You have to know, though, in most countries, those are considered industrial metals because they have industrial applications. Silver has many. Platinum, palladium, obviously, is almost exclusively for industrial purposes. So generally subject to VAT. In Europe, it would be like 12 or 22%, I think. Cayman has a 22% tariff on palladium and platinum bars. So again, you just need to do a little bit of homework before you show up with.
Okay, so those metals. So silver as well is in the industrial side.
In certain countries,
In
yeah.
certain
In Europe,
countries.
in the EU, it's considered an industrial metal.
And so that attracts the industrial side of it in the VAT tax. So only gold is the actual currency.
Gold is very rarely taxed in most countries. Actually, I say that with a big asterisk.
Yeah.
So that's
Exactly.
So
Yeah.
that's again another incredible use case that humanity has put around gold as a unique asset class. I mean, absolutely fascinating.
Well, what's the mix for SWP in those? Are you allowed to say approximately? Do you platinum,
silver?
playdium, silver? Is there?
It's inside this wallet. If you looked around, you'd probably think it's mostly silver, but it's about 80% gold, 17% silver, and 3% platinum palladium.
On a value basis.
On a value basis, yeah. In terms of ounces, definitely silver would.
Right.
Be, yeah.
So, just out of curiosity for the group here, when you think back as to the properties that gold has that has made it as prominent as it has for society as a whole, do we have any idea why gold over anything else? Like, is there a strong case for it, or is it an emergent phenomenon?
Is this you're talking about like the 6,000 years of progression of, or why was gold so important until about 100 years ago? Well, you guys, it's a round easy one. I mean, one of them is it's an asset that doesn't deteriorate easily. Gold doesn't rust, for example. You see those hidden treasures at the bottom of the ocean. They pop open the crate and it still looks like gold. You're like, that's amazing. It hasn't deteriorated in any form. So obviously it has longevity, which is one attribute.
Malleable.
Malleable.
Can be broken
Fungible.
into lots of, yeah.
Yeah, I mean, it's funny now they call crypto or specifically Bitcoin kind of digital gold. I find that really amusing because they love hating on the gold guys, but then they're like, they go and steal it and they actually put a little gold coin with Bitcoin stamped on the front of it. I'm like,
It's good marketing.
yeah.
And I think the other one is that it happened to be kind of spread out around the Earth's crust in every area of the world, right? So it became a ubiquitous metal that you could mine.
Still fairly rare.
And
Still,
still fairly
yeah,
rare.
it's still fairly rare. I mean, it is a little bit unnerving when you watch documentaries about how much Earth they have to destroy or really, destroy the planet to get it. And obviously, nobody likes seeing that. But it's not why I got into the business, but definitely become a reality as I've learned more about that industry. It is destructive.
Well, I mean, it's, lithium. I mean, being Canadian, we've seen a few tailing ponds and oil and gas and all those types of things. So,
But low melting point, definitely, that's a useful feature. And then, of course, the amount that's mined every year is a vanishingly small fraction of the total amount that's above ground, right? So there's just no dilution over time, right? And it's not used hardly at all for industrial purposes, right?
that's a great point in sort of maybe addressing specifically the idea of that, stock to flow type of thing, and the fact that the money supply changes in far greater magnitudes than does that. So if we're going to double the money supply in the world, we didn't double the number of these gold bars. And so that has some implications for the price long term, which is probably why over 6,000 years, again, that durability, that ability to be malleable, the ubiquitousness around the world tends to put a governor on, or as we go through the fiat currency world. I mean, this is the appeal. It's just not easy to replicate.
And a key reserve for any major serious political power, right? So that everybody has a little bit of gold.
Well, it's amazing that political powers or the reserve banks of the world have been acquiring more gold of late. You know,
Yeah.
what's old is new again.
So let's talk a little bit about the influences of the price of gold. If we can unpack some of that. Have you guys? I know you're mostly on physical and trying to provide a service, but what are the drivers of gold, broadly speaking? And then maybe we can get into what
Yeah.
we've seen recently.
Yeah, I'll just kick off the conversation with a few talking points. So from a production standpoint, it is fairly stable year to year. It might fluctuate 2%, 5%, give or take, but it's very stable. Obviously, the market determines how much activity the market price will determine how active mining companies are and so on. Central bank buying has really been the key headline in the last year, providing a floor for the gold price. So China, Russia, some Middle Eastern central banks are loading up, and from the commentary I read, it's really based on geopolitical risk. So you've got a major conflict in Europe. Now you have a second conflict in the Middle East. You've got the BRIC countries, becoming more influential potentially. Maybe closer to home in the States, you've got an election coming up. So all these things factor into central banks and why they might accumulate these assets on their balance sheets. And that's really been supported the price of gold, even in raising interest rate, environment that we saw, which is typically really bad for gold. That's a lot of pressure on gold. So that's one thing that's definitely influencing the price right now.
When they carved Russia out of the SWIFT system, that I think put a lot of global central banks on alert, because it then was a signal that the West was willing to use the monetary system as a lever to exert control, political control.
Selective default, basically, right? So when you think about being selectively defaulted on by the US government on your treasuries, all of a sudden you start to think about, wait a second, are my assets mine, or where are they held again?
Yeah, if you're a non-cooperative state, then conceivably the Treasury could shut down interest payments or fail to redeem the value of the coupons or what have you. Yeah, absolutely. So it definitely is used as a political lever.
And then the other areas of influence that I see that I think tend to confuse people. So I definitely see gold as having this unique property for periods of duress and political turmoil. But all things equal, when that's calm, what you end up seeing is a correlation between the gold price and real returns. And I think that the way gold has moved in the last...
Real rates, you mean?
Real rates, sorry, thank you. The way gold has moved in the last 2 to 3 years has confused a lot of people post 2020 during COVID, because you saw kind of a thrust up. Then you saw demand pull inflation on the commodity front while gold flatlined. And now it's been affected mostly by geopolitical and real returns, right? So what you tend to see is as real rates go down, gold appreciates, which makes sense, right? You're not getting your real money isn't giving you any real returns. You go to gold. As real rates go up, as they have been, this is the confusing part, right? As rates went up and the Fed was actually willing to pay you more for your cash reserves, gold went down. So there is that correlation between those two things that I think oftentimes confuse people. And then the third point of discussion, I was in Toronto the other day with a mining friend, and he was completely baffled by why gold was doing well, but the gold miners were not. And again, that's going back to gold miners, even the ETF, a diversified set of gold miners, you have to disaggregate the actual physical underlying metal and the business that they're running, and what that means. If you're in a negative economic growth shock and there's less people doing business, you are going to get hit in the operating revenues. So those are kind of in the areas of gold, I think, levers that people need to understand so that they can translate what's going on with the price of gold. And it's not just geopolitical, it's not just real rates, and especially when you bring the gold miners, you got to take into account the fact that it's not a pure play.
Stock beta.
It is stock beta, and it's levered on their cash flow.
You couldn't get people to the mines during COVID. Like there was a mining human shortage of workforce. There are all kinds of fun stuff that happens when you're operating a business.
I think also it's worth mentioning that, I mean, gold has failed to make new highs. Well, it just recently made a
what
very
currency,
quick
though?
new high, right? But it's made new highs in virtually every other currency except for the US dollar, right? We're sort of just waiting for that secular breakout in US dollar terms. I guess people are still maintaining sufficient faith in the Fed's mandate to preserve the value of the currency.
And be able to
Well,
pay
it's
it back
because
in
they
dollars that are worthwhile.
That's right, and
down
they
the
aren't nearly
track.
as certain about other central banks.
Well, inflation is much higher in other countries than it is in the U.S. I mean, the U.S. has done more to curtail inflation than European countries. They stopped early.
That's true, but also some of the other countries are not as strong economically, so they can't afford to raise rates sufficiently, despite the fact that they've got this high inflation. So they're still at negative real rates, whereas the U.S. economy was sufficiently strong to raise rates above the rate of inflation and therefore protect the value of the currency. So it's definitely been an interesting couple of years from that perspective.
But again, it just speaks to, as a diversifier, what it is diversifying against, right? There's a lot of confusion about what inflation is. It's a lot of things. And gold does protect a certain portion of inflation. It's devaluation of the currency versus other types of inflation, like when COVID hit and we had supply lines be hit and we had a lot of demand because there was a lot of money in our pockets. That was a demand of goods at a time where there wasn't enough supply. So commodities and other things are going to help you in that environment, and not necessarily gold. So just too many people give up on it because they feel it's supposed to be one thing and it doesn't. So I'm out.
You know, that's a feature, not a bug, I think, that so many people miss, right? The fact that gold doesn't trade for the same reasons and in the same direction at the same time as other commodities. That's why it's such a unique diversifier. And I mean, if the golden rule, so to speak, of portfolio theory is you want to find as many truly uncorrelated, diversifying asset classes as you can, and hold them in the right balance in your portfolio. That's diversification, right? And that's why gold is, I think, so strangely underappreciated. It really is completely different. I like the way Don Cox characterized gold as the only asset that is no one else's liability.
Right.
And it really does serve that purpose, right? When you have some, any sort of debt deflation or, Japan the Bank of Japan explicitly said, we are going to sacrifice the value of the yen. And the benefit of gold is that it's a stable denominator against all currencies, right? And so, gold exploded higher against the yen. The yen fell in value also against the US dollar because the US dollar is still considered to be stable. But at some point, it could very well be that the Fed has to decide between saving the fiscal situation of the US or defending the currency. And you can't do both. That's what happened in Japan, and we may very well come to that in other jurisdictions.
In South America.
Oh yeah, of course.
Sorry to interrupt, but I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful. Thanks again. Now back to the podcast.
So let's explore as to why, when you think about asset allocation, there isn't a lot of demand for anything outside of financial assets. And I think the main point is the fact that people see that you get a return on risk for equities. There is a yield, there's a dividend. There's a return on bonds with whatever yield, a real return that we've seen historically. And the question really is, I think in most allocators' minds, is why would I allocate to gold and commodities that don't seem to provide any sort of cash flow? Mm-hmm. And I think that's why people stop at equities and bonds. Do you have any thoughts on that? Does anybody here have any thoughts on that?
Well, first I would say it a little bit is where you are in stopping there. Right? We just talked about South America. If you're in India, obviously there's a huge culture of accumulating gold as an asset, whether that it's a little bit different. I think it's more jewelry oriented. But so there are specific and different cultural differences, I think, across various cultures in the world. But when you start to talk about the most hyper financialized economies of the world, you start to see, I think, exactly what you're saying, is that there's this, what's the cash flow connection? And then you get into a situation where you had a long disinflationary period that didn't have a lot of inflation, that you saw opportunities for globalization that enhanced the profits that were coming from those businesses, enhanced the ability for bonds to both pay their interest, but also have a predominantly falling interest rate. And so during that regime, you have this sort of the perfect storm for those stocks and bonds that are cash flow oriented assets. And so you do end up having a habit in those areas, in those financialized areas, to say, well, yeah, why would I have gold? It's been nothing but something that's been an albatross around the portfolio.
Barbarous relic, right?
Yeah.
When none other than Warren Buffett says that nobody should own the barbarous relic, then, I mean, you can certainly figure out why many people have shunned it over the years. I want to be respectful of your time too, because we're past.
Yeah, we've got a couple more minutes
Yeah,
for sure.
okay, great.
Yeah.
But I mean, it does serve a unique role in portfolios, but I also, yeah, to your point, hypergeometric discounting, people just have very short memories. What's done well lately? What has hurt me lately? And you chase the hot asset. What's ironic, of course, is that gold has sort of quietly crept higher, delivered returns, somewhere between stocks and bonds. Commodities over the long term, if anything, have been a bit more questionable in terms of their real return value. But gold has steadily preserved value and actually delivered returns above the rate of inflation, even in US dollars. So it is a bit of a mystery why it's not more widely held in portfolios.
Well, I just think the link in terms of logical connection to why it would give us an excess return or any sort of cash flow is missing there.
Well, and I think, yeah, because it's a deep risk that only sort of manifests once every 70 or 80 years. Not enough cycles to give it, statistical or quantitative basis. You can't get a look historically and say, well, gold does well. You look at the correlation between gold's big spikes and other asset classes. How many big spikes have we had in gold? Like they typically happen during forced currency devaluations or coordinated currency devaluations among many developed economies, that sort of thing, right? So because of the sort of spiky nature of the risk that it protects against, I think it's hard for people to price.
So Mark, what is the when it comes to gold production in a given year, what percentage of new gold are we pulling out? Do you know them?
I don't know that number.
roughly?
No, I don't know that number offhand, to be honest. Yeah.
Because I wonder if what's important here is real return on any asset. And if productivity is outstripping the amount of gold that we can produce, then that would generally...
It's a vanishingly small percentage
I think it's sub 2%.
that's produced. And yes, some of that does go into manufacturing.
Activity is above that, then that would create a deflationary asset that would increase its price. It would just, a smaller amount would purchase more from a just pure productivity perspective. And that could be the explanation for real return. And then above and beyond that, if there's outsized returns from a nominal basis, it is connected to geopolitical risk and inflating away a currency, right? So if we can make those links, and from a portfolio theory perspective, I think we can get more people on board. But there's, I'm sure, many things written about that and more that we can.
Well, I mean, Dalio's quip famously is, if you don't own gold, you either don't understand economics or history. Yeah. I mean, it's a quip, but it has, I think there's some, germ of knowledge in that.
Yeah, and just to reiterate, even let's assume that it doesn't. Let's remember that there's a yield that you can extract from non-correlated volatile assets just from simply rebalancing. And we wrote a paper called Optimal Commodities that gets into the types of yields that you can achieve from non-returning commodities simply because they're different and you at different timescales. We kind of go through, I think, daily, weekly, monthly, quarterly, yearly. And you will see yields just purely from rebalancing between 0.5 and up to 4%. So that's another area that's just pure entropy in mathematics that is just too difficult for people to comprehend, right? So again, gold plays an important role, and I'm glad we were able to sit down and talk about it today.
Yeah, no, glad you guys came in. Thanks for sharing your
Thank
ideas.
you so much for hosting. It's quite a quite a place to have a podcast
And
episode.
I think people should remember, if you don't know the serial number on your bar, it's not
don't
your
know.
bar.
But you don't have to memorize it.
Yeah,
You don't have
exactly.
to
We'll take care of that
memorize
for 'em.
27, what is it? How many?
It's 12 words or whatever.
12 words?
So where can people find more info on you and on SWP?
Sure. SWPCayman.com is the website. I'm on Twitter. I don't have that many followers. I don't tweet that often.
You know, if you didn't say that, no one would know.
Yeah, exactly. But you can find me at Yaxley on Twitter. Try to spell that. If you can spell that, that's probably why I don't have a lot of followers. Nobody can
And
spell
you
it. But
do have programs in the U.S. for qualified accounts to buy gold as well, don't you?
yeah, we have a few kind of secondary offerings. People can own gold in their IRAs. Not enough Americans know about that. Not nearly enough
Really?
Canadians.
So in a registered account in Canada too,
Yeah.
you can actually
Yeah.
own physical. I thought you would have to go through some of the physical fund ownership folks. to
No,
do it.
you can buy gold and silver produced by the Royal Canadian Mint for your RSPs or TFSAs in Canada, in your IRAs in the States. Actually, we store IRA gold here in the Cayman Islands, believe it or not. So there's a few interesting ways that you can work it into your portfolio.
Not Irish Republican Army, just to be clear.
That we know of.
Awesome. Well, thanks for letting us come into your vault. This is a real treat, and we hope to do it again, sometime
Yeah.
maybe next year.
Yeah, you guys are welcome back anytime.
For Christmas edition.
Yeah, every
Happy
Christmas.
holidays.
Merry, merry.
Should have had a
Holidays,
drink.
everyone.